Have you ever wondered how the government funds big ticket promises without actually hiking tax rates? Now, a big part of the answer lies in one budget term: tax buoyancy. Tax buoyancy measures how quickly tax revenues grow when the economy expands. In simple terms, it tells us how strongly tax collections respond to GDP growth. Now, think of GDP as the tide and taxes as the boat. Now, if the tide rises and the boat rises even higher, that is strong buoyancy. Here is how it works. If tax buoyancy is above 1, taxes grow faster than GDP. If it is equal to 1, taxes grow at the same pace as GDP. And if it is below 1, taxes grow slower than GDP. For example, if GDP grows by 10% and tax revenue grows by 12%, tax buoyancy is 1.2, showing a responsive tax system. When the government plans the budget, it does not just estimate tax revenue as a random number. It projects collections by combining expected nominal GDP growth with an assumed buoyancy rate. Like in the FY26 budget, nominal GDP growth was projected at about 10.1%, overall tax buoyancy was estimated at around 1.07, and direct tax buoyancy, especially for income tax, was close to 1.4 even after tax cuts. So this helps the government set revenue targets in advance, including rising direct taxes as a share of GDP without raising tax rates. The government cares because higher tax buoyancy makes budget planning easier. It means more reliable revenue projections, better control over the fiscal deficit, and less dependence on borrowing. Strong tax buoyancy helps fund infrastructure, defense, welfare schemes, and day-to-day government spending while keeping public finances stable. Low buoyancy, on the other hand, can be a warning sign, often pointing to evasion, loopholes, or weak compliance. Now, you should care because this affects your everyday life. When tax buoyancy is strong, the government has more room to spend without putting pressure on future tax hikes. So it can support public services and reduce the risk of sudden fiscal shocks. But when buoyancy is weak, the government may have to cut spending, and that can affect your jobs, healthcare, infrastructure, and growth. In Budget 2026, watch whether the government expects tax revenues to grow faster than GDP. A buoyancy figure in the range of 1.2 to 1.5 would signal stronger revenue strength. But there is a limit. When economic growth slows, even tax buoyancy cannot do all the heavy lifting. And that is when governments look beyond taxes to raise money through non-tax revenue, including selling public assets. And that process is called disinvestment. In the next episode of Budget Basics, we explain what disinvestment is and why the government relies on it. This is Budget Basics by Business Standard, breaking down the budget minus the jargon.